These are 8 stocks that I actually own in my Charles Schwab stock portfolio, and in this video, I'm going to be showing you all of them. They represent the companies that I think have the best chance of having a very positive return going forward. And if we open up my actual stock account, I like to be transparent on this channel, we can see that year to date, my portfolio is up around $14,000 or 13%. Or is it actually down 8% over the last 6 months? Or maybe it's up 15% over the last 3 months. Or maybe it's down 6% over the last 1 month. The stock market has been an absolute roller coaster over the last 6 months, especially for tech stocks like I invest in. But in this video, I'll be walking through 8 high conviction positions that I'm investing in and explaining exactly why I own those companies. And remember, I'm putting all my personal money behind these stocks, so I'm actually putting my money where my mouth is. And stick around until the end of the video to see which trades I've made in the past month. So let's start by looking at my first and largest stock position overall, which is Datadog. I currently own 330 shares of Datadog at a market value of just under $24,000, and that's down off a cost basis of $32,000. So in total, it's lost around $8,500 overall. And you can see that Charles Schwab is giving this stock an F rating. Now that rating doesn't actually have to do with how much Datadog is down so far or how far it's going to continue to drop. As far as I can tell, Charles Schwab does sort of a value-based analysis of these companies to give them the rating, and so it doesn't work well for high growth companies. For example, I used to invest in a company called CrowdStrike where I made a 300% return over around a year and a half, and it had an F or D rating with Charles Schwab that entire time. So I don't put too much stock in those numbers. But here's why I'm actually investing in Datadog. So Datadog is a data company. They unite a company's application, security, and infrastructure all through a single pane of glass. Basically, as companies generate more and more data, Datadog benefits from that. And we can see that by looking at their actual numbers. If we look at their revenue from a year ago, they were growing at 83% per year. Then they grew at 74%, then 61%, then 44%. Now, even though this rate of revenue growth is dropping, it's still extremely high for a company that's making nearly $2 billion in revenue per year. And while the company is not technically profitable according to GAAP accounting standards, if we look a little bit beneath the surface, they have a very positive adjusted free cash flow, meaning they're throwing off basically $100 million in cash every single quarter, and they have very high adjusted gross margins, sitting at around 81% in Q4 2022. While this company may face some temporary headwinds as we see a downturn in the stock market over the next several months, in the long term, the general trends of cloud growth and data proliferation are going to benefit Datadog. Plus, they operate in the B2B space, meaning they sell their products to other businesses rather than consumers, which tend to be a little bit less fickle about canceling contracts even in an economic downturn. And hey, by the way, welcome to FinTech. If you find anything valuable in this video, please just let me know in the comments and I'll try to respond to all of them. And I know some people are probably going to say, oh, this is the same portfolio that you showed last month and the month before that. And you know what? That is true. But I also think that if your portfolio is changing every single month, you're probably doing something wrong. I think Warren Buffett said something like that. But make sure you watch until the end and I will show you what new trades I made in the past month. So my second largest stock position overall is in a company called Snowflake, which I own 160 shares of at a value of $22,500. This one has also dipped over the last few months, down from around $29,000 down $7,000 since then. Now Snowflake also operates in the data space like Datadog, but it works in a very different way. One analogy that I've used before is the change from old school handwritten data that's taken in basically a piece of paper on a note sheet, and how that eventually moved over into basic computers, almost like Excel spreadsheets. Then that turned into more advanced databases, then data warehouses, then the cloud. But Snowflake is taking that one step further. Snowflake has invented the data cloud, which lets them manage all the data access, collaboration, monetization, and even building tools that other companies can use to actually run useful applications on their data. This makes it an order of magnitude less effort for other companies to use the data that they're generating. And so they're paying Snowflake less than they're getting back by using the data. Now that's all a nice story, but let's look at Snowflake's numbers. Snowflake, like Datadog, if we look at their most recent quarters, is not profitable. In fact, they're running a negative net profit margin of 35%. But also similar to Datadog, they're throwing off an incredible amount of cash. They're producing $65 million in free cash flow every quarter. Now, I'm not going to say that profits aren't important, but in a lot of cases, especially in an economic downturn, cash is actually even more important. They're also running adjusted gross margins of 75%, meaning that the core business is actually making money. They just have to make enough money to offset all the costs that they have from their engineering department mostly. But most important with Snowflake is their customers absolutely love their product. They have a dollar-based net expansion rate of 165%. This means that for every dollar a customer spends this year, they can expect that same customer to spend $1.65 next year. That means that even if Snowflake didn't market outside the company at all, they would effectively effectively grow at 65% year over year just from their existing customers. And if we look at their revenue over time, we can see how this growth rate is happening. A year ago, they had revenue of $422 million, up 84% year over year. Then they had 82% growth the next quarter. Then they had 66% growth the next quarter. And in their most recent quarter, they had 55% growth while making almost $600 million in revenue. Now, obviously, as the company gets bigger and bigger, that percentage growth is going to decline over time, but their absolute growth rate is still incredibly high. And a lot of that has to do with the fact that the customers just really like their product, which is why that's my second largest position that I invest in. But speaking of investing, it's important to make sure that your online trades are secure. And this video sponsor, ExpressVPN, can help you do that. Sending data like your stock trades over an unencrypted internet connection is kind of like mailing a postcard without an envelope. The mailman can see it, and so can anyone else who's nosy enough to take a look. And whenever you're connected to an unencrypted internet connection on your phone, your computer, or even your TV, you're sending out data into the world that could be intercepted by someone before it gets to its intended destination. But if you use a VPN, it creates a secure tunnel to your destination. It's kind of like putting an envelope around your postcard before you send it out in the mail, so no one else can read your message. And by using the link in the description, ExpressVPN can help you start protecting your data today. Did you know that many ISPs, which are the companies that give you internet, can legally sell your data to advertising companies? Well, ExpressVPN stops this by rerouting 100% of your network traffic through their secure encrypted servers. ExpressVPN also masks your unique IP address, making it much harder for big tech and advertisers to track you across the internet. But that's not all a VPN does. I personally signed up for ExpressVPN for a completely different reason, because did you know that you can actually watch shows that aren't available in your region by using a VPN? Many companies like Netflix only offer content in certain regions, like say the UK. But with ExpressVPN, I can set my region to wherever I want and watch shows as if I'm sitting in the middle of London. Now I just need another season of Sherlock to come out. And if you sign up using the link in the description today, you'll get 3 free months with ExpressVPN. So check that out by going to the link in the description now. Now the third largest company that I'm investing in is Cloudflare, which I own 317 shares of at a value of $18,000, and this one's down only a little bit, from around $20,000 overall. And even though this shows this is a loss, this is partly due to how Charles Schwab calculates their gains and loss. Because I actually sold some of my Cloudflare when it was at a higher price and then bought more around that same price, it raised the cost basis that Cloudflare is calculating. It basically uses a first in, first out formula. So even though I've actually made quite a bit of money on Cloudflare, this is calculating my loss based on those more expensive shares that I bought more recently. But why am I investing in Cloudflare in the first place? Well, Cloudflare is one of the more interesting companies on this list, and that their goal is to make the internet itself work better. I won't go into all the products that Cloudflare offers because honestly, I could make an entire channel just dedicated to Cloudflare, but I would consider them probably the most innovative company on this list. They offer products ranging from website security to improving website performance to actually offering platforms that developers can build on top of. If you know anything about cloud development, they're basically starting to compete with companies like Amazon, Microsoft, and Google with their cloud systems, which would be almost unheard of for a relatively small company to do 5 years ago. Now, one of the reasons Cloudflare has managed to do that is because they are growing extremely consistently. They've grown at over 50% revenue year over year for more than the past half decade. Similar to the other companies on this list, Cloudflare is not yet profitable from a GAAP profit margin perspective, but they are getting closer and closer to becoming profitable every single quarter. And in their most recent quarter, they reported positive free cash flow for the first time of $34 million. And I consider that a very good thing. As we enter a potential recession, that cash gives them the ability to make choices. If they need to buy a competitor, they can do that. If they need to cover a shortfall in one quarter's earnings because there's a sudden downturn, they can do that. Again, while profitability is important to investors, what matters most to companies is cash flow and the ability to keep on growing. I would much rather a company continue to invest in growth and taking over a market than to start taking profits too early and completely cut off all that growth, allowing a competitor to come up, catch them, and then pass them. This is basically the exact strategy that Amazon took for around 20 years when they didn't turn a profit until they were already a multi-billion-dollar a year company. Number 4 on my list is SoFi, which I currently own 1,900 shares of at a value of $12,000, and this one's actually up a little bit, up from a cost basis of $12,000 overall. Now, SoFi is an interesting company because of all the turmoil that's been happening in the banking industry recently. SoFi plans to be the future of banking, basically focusing on millennials and Gen Z who make far above the average income to focus on them as customers. Now, a lot of people might know SoFi from their financial services, things like the SoFi Invest app, but that's actually just a microscopic portion of SoFi's business. The vast majority of their business comes from their lending segment. SoFi basically basically uses their financial services to capture interest and bring in new customers, and then they funnel those customers into the more valuable areas of the company where they actually make their money. This creates sort of a feedback loop where you get a customer on board and then you can cycle them on to more and more valuable parts of the company over time, and as long as you provide them a good experience with each product, they're more likely to use more of your products over time. Now you can probably guess the name of the game here. SoFi is not yet profitable, but they are growing extremely quickly, with revenue growth of 57% in their most recent quarter, growing 51% before that, 52% before that, and 62% a year ago. Now SoFi is a little different from the other companies on this list in that they're a mix of both tech and banking. Now the banking side carries its own set of risks that are completely independent from the tech side. Economic downturns can really affect how much cash they have on hand, and lending plays a big role in their business. Because of that, I don't have as much confidence forecasting SoFi in the short term, but over a longer time period, let's say 5 to 10 years, I have a lot of faith in SoFi as a company, which is why this is my 4th largest position. Next, we have my 5th largest position overall, which is a company you probably haven't heard of called Zscaler. I currently own 82 shares of Zscaler at a value of $9,500, and this one's actually down pretty substantially, down from around $19,000 overall, so it's down almost 10 grand. With a pretty substantial portion of that drop happening in just the last month. They're down almost 16%. Now Zscaler offers a security product called Zero Trust Security. If you think of old school security, it basically works like a wall and a moat. You build a firewall around your network and you keep all the bad guys out. It's almost like protecting a castle. The problem is if a bad guy can get over that wall and into your network, they have free reign to mess up everything inside that walled garden. But with Zero Trust Security, every application, computer, and person on the network has to authenticate anytime they're talking to anybody else. This makes the network much more secure, and it makes a lot more sense in a cloud-based paradigm when a lot of time your applications are running on servers that could be spread across the entire world. Zscaler is the leader in Zero Trust Security, and as more and more companies are moving to the cloud, more of them are going to be implementing this kind of security. Now Zscaler is not GAAP profitable, but they do have very positive adjusted gross margin at 81%, and they are producing substantial free cash flow. The biggest downside with Zscaler and why it's not one of my largest positions overall is the fact that their growth has been slowing, down from 71% billings growth year over year in 2021 to 37% billings growth in Q1 2023. And since Zscaler's billings tend to predict where their revenue is going to go, we may soon see a drop in Zscaler's revenue year over year as well. That being said, there are still good signs with this company, like the fact that they're making more free cash flow than ever, they're having strong adjusted gross margins that are maintained high, and their stock-based compensation as a percentage of revenue has continued to drop over time, which means that eventually they may even become GAAP profitable. Next up on our list, we have 2 companies that offer very similar products, and so I'm going to talk about them at the same time. Those are SentinelOne and CrowdStrike. SentinelOne I own 582 shares of at a value of just under $9,000, and CrowdStrike I own 55 shares of at a value of just under $7,000. Now CrowdStrike I've bought in and sold out of a couple of times over the past several years, but right now this is the size position that I'm comfortable with in this company. Now interestingly, SentinelOne is down pretty substantially from my initial investment, down around 33%, so I've lost $9,000 in it, and CrowdStrike is actually up over around the same time period, up nearly $1,000. Now both of these companies offer basically super advanced antivirus software for enterprises. They use AI to analyze different viruses and threats so that they can proactively predict where the next threat will come from. Instead of simply creating a database of past attacks and then trying to recognize those attackers and prevent them from attacking again, they can proactively prevent future attacks. CrowdStrike, for example, made a name for itself when they successfully detected and mitigated the SolarWinds breach with their customers. That breach, if you don't know, was one of the largest security breaches in history, with more than 18,000 customers who installed malicious updates. This included companies like Deloitte, Microsoft, Cisco, and it included government agencies like Homeland Security, State Commerce, and the Treasury. But guess whose customers weren't affected by this? CrowdStrike's. Now CrowdStrike and SentinelOne are also cloud-based security providers, meaning that as customers move to the cloud, these are the kinds of software tools that they're going to be looking for. CrowdStrike is kind of like a more mature version of SentinelOne. Right now, CrowdStrike makes $637 million in revenue each quarter, and it's growing at under 50% year over year, while SentinelOne is making a much smaller $121 million per quarter, but growing at a much faster 92% year over year. In a lot of ways, SentinelOne looks exactly like CrowdStrike did several years ago, which coincidentally is when I was investing in CrowdStrike and made the biggest 300% return that I've had in a single stock. Now, right now, I'm okay with owning both of these companies because I think security and cloud-based security especially are growing trends that are going to benefit multiple winners. And I like owning CrowdStrike as sort of the big elephant in the room in the security space, as well as SentinelOne, who's the up-and-coming super fast grower who has a lot of potential. So okay, we just covered 3 security stocks, so now let's go to a totally different area, probably to an area you've never even thought about before. Have you ever heard of back office financial automation for SMBs? Probably not, because it sounds super boring, and it kind of is, which is what makes it such a great investment. My last and smallest position is not a flashy company, it's not super sexy, it's not in a very interesting industry, but it's called Bill.com. I own 74 shares of Bill.com at a value of $5,500, and while this company is down over 50%, down $6,500 overall, I have a lot of confidence in it going forward. Bill.com is unique in that it's not targeting big enterprises like a lot of these other companies on here. Instead, it's trying to sell its services to small startups and businesses that maybe only have 1 or 2 employees. Those companies manage their entire businesses using physical papers and Excel spreadsheets or Google Sheets. They're not super sophisticated, and so any improvement can make a big difference in their business. Bill.com helps automate and professionalize a lot of those basic services, taking them from Excel spreadsheets and into a software suite that they can grow into. Now that on its own is a very valuable service, but what's even more valuable is the fact that Bill.com identifies all of these small startups when they're still small, gathers a bunch of data from them, including who they're paying money to and who's paying money to them, and is able to create a network of other companies that they can then market to. Now, are they profitable? You can probably guess no. They have a net profit margin of negative 35% if you use GAAP accounting, but they are growing like crazy, growing 66% year over year in terms of their revenue in their most recent quarter, growing 94% before that, growing 155% the quarter before that, and growing nearly 180% the quarter before that. Now, one of the reasons those revenue growth numbers are so crazy is because Bill.com has been acquiring a lot of other companies as well, which skews their revenue number temporarily in certain quarters. But if you look at their organic year-over-year revenue growth rate, they still grew 49% in the most recent quarter. Bill.com is also producing positive free cash flow, and so even though they are not GAAP profitable in the short term, they do still have some cash to work with. Now, I should distinguish here between GAAP profitability and non-GAAP profitability. Some of these companies are non-GAAP profitable, which means they're profitable if you exclude stock-based compensation. This is how they pay employees, especially high-paid engineers and executives, where they're not actually giving them cash, they're just awarding them in stock. This is a good thing for small companies because it doesn't affect their operations, but it does weigh down on their stock price overall. GAAP profitability means that they are profitable even if you subtract out this stock-based compensation. And so it's much harder to achieve for a small, fast-growing company. For a company that's growing quickly, I would much rather them pay their employees in stock-based compensation instead of pulling money out of the business, because that's going to be a bottleneck that holds them back. But you don't want their stock-based compensation to get too far out of hand. You don't want them to just be paying people just because. And so that's where GAAP profitability can have a place as well. I just wanted to explain that because I know I've seen a lot of comments around how none of these companies are profitable, but I want to be clear that that is a very vague term and can have different meanings in different contexts. Now, I also promised at the end of this video I would let you know what trades I made in the past month. So I only made one trade in this month, and that was buying a mix of large cap and mid cap stocks using VFFSX, which tracks the S&P 500, and VMCPX, which tracks mid cap stocks. I put $3,000 into both of those two index funds just like I do every single month. In fact, this is where the majority of my money goes into every month. It's not as flashy as investing in individual stocks, and it's not as interesting, but that is the basis for how I plan to build wealth in the long term. But let me know if you own any of the stocks I talked about, or if your portfolio has done better than mine over the past year. Let me know what stocks you've been investing in to do that. On this video, if you leave a comment, I will try to respond to all of them. There are going to be some bots in the comments, so I'll try to get those deleted as well. Don't forget to like and subscribe. Maybe check out ExpressVPN using the link in the description, and I'll see you next time.